And now we come to trade of the day, the highlights of this week's trades. Let's get into it. Good evening and welcome to Follow the Money, bringing you the latest updates on everything finance, business, the markets, and investment funds. In a notable shift, US mortgage rates have dipped this week, marking the first decline in over a month. However, experts caution that these rates, while lower, remain too high to boost the housing market significantly. According to Freddie Mac, the average rate on a 30-year fixed rate mortgage now stands at 7.9%, down from 7.22% last week. This comes after 5 consecutive weeks of increases. A year ago, the average rate was notably lower at 6.35%. The decline in mortgage rates corresponds with a decrease in a 10-year Treasury yield, indicating a slowdown in economic and job growth. Rates hovering above 7% still poses challenges for both buyers and sellers. Freddie Mac chief economist Sam Carter emphasizes that these high rates deter potential sellers from listing their homes, contributing to a limited supply, keeping house prices elevated. This, in turn, adds to the affordability struggles faced by potential buyers in the market. Also, on Follow the Money this week, investors have withdrawn a significant $9.9 billion from the hedge funds in March alone, marking a 22nd straight month of outflows surpassing inflows, according to NASDAQ eVestment. Despite positive performances across all strategies, inflows from investors remain consistently low, indicating hesitancy in making new allocations. Among the standout performers were alternative risk premier hedge funds, which had an impressive return of nearly 12% for the quarter. Managed futures, another successful strategy, returned approximately 4%. However, only 4 out of the 10 strategies saw inflows. Multi strategy hedge funds, homes to some of the industry's giants, experienced the largest outflows of $27 billion. Despite the exodus, estimated assets overseen by multi strategy funds surpassed $700 billion, reaching an all time high. Overall, there seems to be cautious sentiment among investors despite the hedge funds industry's overall positive performance. That's all for Follow the Money this week. Thank you for joining us. Join us again next week for the latest updates in the world of money. Back over to the studio for Trade of the Day. Welcome to Trade of the Day, our groundbreaking weekly trading series where we reveal the secrets to achieving consistent weekly returns in the fast paced world of day trading. Join us every week on this exhilarating journey as we decode the strategies and mindset needed to harness the power of the markets and unlock remarkable financial growth. Whether you're a novice trader seeking to build your wealth or a seasoned investor aiming to amplify your gains, our series is your roadmap to success. Get ready to revolutionize your trading approach and embark on the path towards achieving your financial dreams, one week at a time. Also, we love to know where in the world you're tuning in from, so post in the comments below. A reminder, this is not financial advice and that trading comes with real risk. My name is Alice, and I help traders and investors who struggle with confidence to make money in the financial markets, find consistency and scale to achieve financial freedom, time freedom, and location freedom. I believe trading is the greatest wealth building tool of all time, and everyone on this planet needs access to the skills. I'm on a mission to impact 1 million people through trading by 2030. Let's go. Coming up this week, this is how you could have made 5% in the market, taking one trade a week using one model, risking no more than 2% of your equity, looking to make 1 to 3. So risking 2% to make 6%. This week really opened my eyes to the opportunities that the model offer. I realized that I don't need to force setups and I can wait for A plus setups and not feel like I'm missing the move or that the market is moving without me. My patience really grew this week for sure. I feel myself becoming more calmer in trades. Okay, it's a really good feeling. As I develop and grow as a trader, this series and the information provided here will improve as well. Everything I share here is how we at I'm the Trader trade. We had a total of 4 trades this week for potential profits of 24%. But remember, our target for the week is 5%, so meaning we only needed one of these trades on your screen to pan out. But before we dive deep into this week's trade of the day, let's talk about having a trading edge and what that entails. A trading edge is one of the 3 pillars every trader must have in their trading to survive and thrive in the financial market. If you don't have these three pillars in your trading, you're setting yourself up to fail. Confidence in your trading edge comes from three things. One, understanding the market and how it operates. Two, having one trading model that has IPTA signatures. Three, having a plan and process that you follow every single day. Successful trading, guys, is really boring. You're doing the same thing over and over and over again. This is the three-step process I use to take trades weekly. One, we have condition. This is based on the higher time frame directional bias. Two, stage. What sets up your trade? What does it look like? Three, execution. Can you execute? Have your entry criteria been met to get in that trade? The most important step is step two, because once you understand where the market is going and you understand the setup, the entry is easy. Also, guys, if you understand price flows that occur around key highs and lows, you'll have everything you need for a setup. Shh, don't tell nobody. Step one, condition. Determine the higher time frame directional bias. Where is the weekly candle likely to go? What is it reaching for? This will give you your condition going into the week. Several factors go into determining the higher time frame bias. However, there are only two options here. It's either you expect the weekly candle to expand higher or to expand lower. Step two, stage. What sets up your trade? What does it look like? First, we look at the economic calendar. It lets us know when to look for a setup. We look for medium to high impact news drives to narrow our focus. We stalk setups on calendar day and after the news release. The optimal days to trade this week were Wednesday, Thursday, and Friday. Secondly, we'll look at what sets up your trade. What does it look like? This will be your model. If your weekly analysis suggests that the price is going higher, then you're in a buy program and should be hunting long formations. For our buy model, we want to see price trade below a key low. Displacement higher causes a market structure shift. The displacement leg must leave a fair value gap busy near the swing low. We wait for a swing high to form and then anticipate execution. If your weekly analysis suggests that the price is going lower, then you're in a sell program and you're hunting sell formations. For our sell model, we want to see price trade above a key high, displacement lower causing a market structure shift. The displacement leg must leave a fair value gap CB in it, okay? We wait for a swing low to form, then anticipate execution. Once the stage is set, when and how do you execute? For execution, we're looking to enter on a fair value gap or order block created in a displacement leg that caused market structure shift. You have two options. You can either enter a limit order at the fair value gap or a limit order at the order block. We use the fair value gap. You can also use the low hanging fruit option, meaning the one closest to price. Stop loss will go below the swing low. You're targeting a 1 to 3 always. It's important to know that you can have both model forms within the span of a day or a week, but your higher probability trades will be in the direction of your weekly program. Here are some factors to consider for high probability setup. First, we have time, the most important aspect of trading. At what time is the setup occurring? Range. Where are we within the range? Are we in the upper, mid, or lower quadrant with respect to buy or sell? Liquidity. Is there liquidity or does price create liquidity right in front of the fair value gap or order block? With regards to the liquidity, once price takes that liquidity, you should see immediate reaction, okay? So completely shoot the direction that you want it to go. Lastly, when can you no longer enter the trade? When is your cutoff point? For me, when once price leaves the 0.25 fib extension, I no longer want to enter the trade. Trading is a solo sport. You have to make it unique to you and your personality. All of this sounds complicated, I'm sure, if you're hearing it for the first time, but it's really simple. You just need to keep showing up on the charts and look for it. Now, let's head over to the charts and look for it in price action this week. Welcome to Tracking IPTA. Woo! What another great day of price action. I'm very pleased with myself this week for following my plan and my processes. Ended the week up 4%, which is $1,000, and overall we're up on the account at 12.7%, which is $3,175 in just 2 weeks, guys. Let that sink in. Let's get to hunting. Grab your tools. As always, we'll be looking at the charts in bar replay mode. This means that you won't be able to see my executions. However, you will be able to see my horizontal lines, which represent the time aspect of trading, okay? The most important tool you need to track down IPDA. Now remember, though I'm going to show you both buy and sell setups, it's important to note that your higher probability trades will form in the direction of your weekly program. You can take counter trend trades with this model. For example, you can take sell setups even if your higher time frame condition is bullish, and vice versa. It's just your probability of winning reduces significantly when you go against your higher time frame directional bias. If you're new to trading, I do suggest only taking trades in the direction of your higher time frame. We're going into this hunt with the understanding that you guys have already arrived at your higher time frame directional bias. So this is a hunt for just setups, okay? To the hunt. Let's go. Tuesday, May 7th, trade of the day breakdown. Now, today we didn't have any news according to Forex Factory, but we did have a great setup form, okay? 1:30 p.m. session starts. We have price trade above a key high, displacement lower causing a market structure shift. We're waiting to enter on a fair value gap created in the displacement leg. Our entry would have been at this top of this candle. You've been tagged in that trade at 138, breaking even at 142, time getting out the trade at 149 for a total time of 11 minutes in that trade. Drawdown in that trade was 5 ticks. This was a A1 setup, okay? We had the time factor, we had the range, we're in the lower quadrant of the range. We had liquidity created in front of the SIBI, which is, this was a A1 setup. Stop loss above the swing high, and you're targeting a 1 to 3 always, okay? 11 minutes in this trade for a 6% bagged and tagged in the bag. You're coming home with me, baby. Wednesday, May 9th, trade of the day breakdown. Let's go. As you can see, we had medium impact news coming out at 1 p.m. PM session, we had price trade above a key high, displacement lower causing a market structure shift, displacement the leg that causes the market structure shift left fair value gap SIBI in the displacement leg. We're looking to enter on a fair value gap created in the displacement leg, okay? For A1 setups, we're thinking about time. At what time is this happening? We're in the PM session. The range, we come up into the upper quadrant of the range, which is in a deep premium for sales. And then no liquidity was created in front of the fair value gap, but everything else was there, okay? So you would have been tagged in this trade at 240, breaking even at 258 at negative zero point 0.5 fib extension, getting out the trade at 301 for a total time of 21 minutes in this trade. Drawdown in this trade was 8 ticks, all right? So tagged you in and woo, immediate reaction, okay? That's how you know it's an A1 setup. That's it for Wednesday, May 8th. Another 6% bagged and tagged 1,500 in equity wise if you're looking at a 25K account. I actually got in this trade this week. I got in this trade right here on this fair value gap, thinking, okay, we took buy side. We also took buy side above the key high, displaced lower, caused the market structure shift. The only thing different here that didn't make this setup at A1, why I believe I was taken out, is because the fair value gap basically wasn't near the swing high that caused the market structure. It was lower down. So I got in here, put my stop loss above here, as you can see, came in, took me out. And then I saw the real trade happen because I already took a loss. I was hesitant to get in this trade, but then I saw the signatures that okay, it was a good trade to be on. I got back in. I got in at this bearish order block right here. I don't know why I put my stop loss up here, but I put my stop loss out here. The stop loss placement also determines your risk to reward. Okay, so that's why I'll broke even on this day. But anyway, 6% bagged and tagged in the bag if you follow the model. Thursday, May 9th, trade of the day breakdown. Let's get into it. We have news coming out at high impact news coming out 8:30 and 1 p.m. Time opening range. We're looking to see what price is doing. As you can see in the opening range, we're not looking to take trades. We had price displaced lower, trade to and through a key low, displacement higher, causing a market structure shift. As you can see, the opening range, we set up the stage for a buy. 10 o'clock come, we're looking for the signal to jump on board. We're looking to enter on a fair value gap created in the displacement leg that caused the market structure shift. And we have a fair value gap right here. I include the volume imbalance because that's really where the discount array starts from. And as you can see, we have everything, all the elements for A plus setup. We have the time, which is post 10 a.m., which was when look AM sessions, we're looking for entries. Range, as you can see, we retrace below in the lower, we're in the lower quadrant of the range. Liquidity is created in front of the of the fair value gap BISI, and it takes, as soon as it takes that liquidity, boom, you see immediate reaction. Okay, and that's what you want to see. So you would have been tagged in this trade at 10:19. We don't get a break even, we go straight to again taking out the trade at 10:37 for a total time of 18 minutes in this trade. Drawdown in this trade was minimal, it's 3 ticks for another 6% bagged and tagged. Okay, Thursday PM session also offered us another setup. We had a sell formation form on Thursday PM session. As you can see, price trade above a key high, displacement lower, causing a market structure shift. The displacement legs leave a fair value gap. SIBI in the displacement leg, we had two. We had one right here, small, but it's there. And we had another one right here. Remember, we're looking to enter on the fair value gap created in the displacement leg. For A1 setups, we're looking at the time. At what time is this happening? We're in the PM session. In the range, we're in the upper quadrant on premium of the range. We don't have liquidity, but everything else is there. Okay, so your entry would have been tagged in, would have gotten in this first low hanging fruit, the first fair value gap right here. You would have been tagged in at 306, breaking even at 316, getting out that trade at 333 for a total time of 27 in that trade. 27 minutes in that trade. The drawdown in that trade was 17 ticks. All right, so when you're on side, when you get A plus set up, you're really on side. Okay, you're in the trade minimal time and you're out. You know immediately whether that trade is going to be a win or it's going to be a loss. Thursday, 2 trades in one day. We had a buy in the morning and a sell in the afternoon for another 6% bagged and tagged, 12% for Thursday. This is another reason why, if you've made money in the beginning of the week, you don't need to be in the charts on a Friday. Okay, we did have a trade of the day form on a Friday. I'll break it down and I'll let you know why you shouldn't have gotten this trade. We all start with the economic calendar. News coming out at 10 a.m. So we're waiting for post news to anticipate setup. PM session starts. We have price trade below key low, displacement higher causing a market structure shift. The displacement higher left the fair value gap CB in a displacement, which is setting up the stage for a buy. We're waiting for price to retrace below 0.25 to anticipate a setup. Okay, we're looking to enter in the fair value gap created in the displacement leg that took market structure. We always use the low hanging fruit. So the first fair value gap that you see, that's where you would place your limit order. So you would be then tagged in this trade at 235. We don't get a break even. We don't get timeout. You're still in this trade. It's a Friday. Like, what are you doing in the market? You can't expect too much from the market on a Friday. So as you can see, I did get in this trade. I broke even out here because once again it was a Friday and I wasn't expecting much. Still in this trade. But this is the reason why you shouldn't trade Fridays if you've already made money in the beginning of the week, which you already had. Okay, so that's all for tracking IPTA this week. See you next week. This week, we showed you multiple opportunities that could have netted you at least 5%. With a 2% risk, if you had taken all four of these trades, you'd be looking at 24% for the week. But remember, we're only looking for one trade that will net us 5% and we're done trading for the week, meaning you would have been done trading for the week on Tuesday. After Tuesday's trade, even if you didn't get Tuesday's trade because there was no economic calendar, you would have been done trading after Wednesday. All right. I hope you found Trade of the Day insightful and hopefully you enjoyed this one. Deciding to become a trader is the greatest decision one will ever make. It is the fastest way to build the life that you want. And too many of us fail at it because we're not equipped with the right tools to ensure survival, let alone thrive. There is a way to succeed at trading. Trade of the Day is about showing you how we at I'm the Trader are doing it and how you can do it too. Always remember, this skill is not easy to master, but it's also not impossible. You only fail when you quit. Thank you for watching. See you all next Saturday, same time, same place. Happy hunting.